In this video, we're going to talk about the central bank, its role in changing monetary policy, and the overall effect on the economy. By changing the money supply, a central bank, the Federal Reserve in the United States, can change the interest rate. Changes in the interest rate affect the economy of a country. There are two types of monetary policy. First is expansionary monetary policy. This is a policy where the central bank increases the money supply. The second type of monetary policy is contractionary monetary policy. This is a policy where the central bank decreases the money supply. Now let's take a look at how expansionary monetary policy and contractionary monetary policy affect the economy. Suppose the central bank observes that the economy is slowing down or is becoming stagnant. In this case, the central bank will enact expansionary monetary policy. To do this, the central bank will increase the money supply. In the graph on the left, we can see this increase in the money supply in the rightward shift of the money supply curve from MS0 to MS1. As a result of this increase in the money supply, the equilibrium interest rate decreases. In the graph, the equilibrium interest rate decreases from R0 down to R1. When the interest rate decreases, it becomes cheaper to borrow money. Therefore, both consumption and investment increase. As a result of the increase in both consumption and investment, the GDP also increases, a sign of economic growth. The unemployment rate decreases, and the inflation rate increases. Now suppose the central bank observes that the economy is growing too quickly and the inflation rate is rising considerably. In this case, the central bank will enact contractionary monetary policy. To do so, the central bank will lower the money supply. In the graph on the right, we can see the lowering of the money supply in the leftward shift of the money supply curve from MS0 to MS2. As a result of the shift, the interest rate increases in the graph from R0 up to R2. When the interest rate increases, it becomes more expensive to borrow money. As a result, both consumption and investment decrease. When both consumption and investment decrease, the GDP also decreases, a sign of economic decline. The unemployment rate increases, and the inflation rate decreases. Thank you for watching. Please like, share, and subscribe.